Hello and welcome to another acysecurities market update. My name is Alistair Schultz and I'm going to be your host through today's trading journey. The first thing I always cover is a little bit of a COVID-19 update. We have more than 2.5 million infections globally and more than 177,000 deaths so far. Naturally, we're expecting this to sort of continue to rise for a little while, but we are starting to see some good news, particularly out of Italy, where they have reported that the rate of recovery has started to surpass the rate of daily infection. So that might be a little bit too soon to say that we are really on the mend, but it is good signals. And it's really too small of a sample size to say that this is going to be enough to really cover it. But we do need to keep an eye on what's going on because it could impact how we sort of see markets moving forward, especially how people are starting to think about a recovery side of the epidemic. Now, the next thing to sort of cover is on the tip of everyone's tongues is oil. And more specifically, I want to talk about a little bit of differences. Now, I've seen a couple of emails that have come in through the Talk to Our email address, and a few people have got some concerns and questions about the idea of why oil prices in the futures market differs to what we see in the CFD market. More particularly, why were we seeing minus $37 on a futures contract yesterday, yet we're seeing positive numbers on the CFD side? And there's really good reason for this. And it's actually because when it comes to CFDs in the spot market, they look at the most forward contract available. So in this instance, the pricing that you see behind us was based on the June contract yesterday. It is taking into account that that's going to be the next oil price and is considered the most up to date. Now, the contract that we saw yesterday tanking right the way down and people were literally paying you to take the oil away from them has been purely because of the supply and demand sort of side of things. Now, what do I mean by that? That's another question that's sort of come up. Well, what are really the supply side, demand sides? Well, in this instance, it's kind of split down the middle now. We have both a supply issue and a demand issue. We have less demand than what's really warranted and needed, and we also have way too much oversupply. To put this in perspective, right now there are approximately 20 million barrels of oil sitting right off the California coast. So there's a lot of oil just to be sitting there in a shipping container, not knowing what's going to happen with it. Now, we need to really think about moving forward how we're going to judge the price movements of oil. It's within my firm belief that the only way we see oil prices start to come back up is via a cut of supply. So we reduce how much oil is actually being tapped and put into barrels, which would hopefully put a little bit of easing on the storage consumption costs. So we need to really keep an eye on how that's going to happen. If we do see a cut, I think it'll be quite a quick turnaround in price. We might see it in a couple of weeks. But if we don't get that change in demand as well, then it could be strung out for a much longer period of time. It's all well and good to cut oil and cut the supply of it, but if you don't have any demand for it, then that's going to be problematic in the long term. The next piece of oil really comes from something I was talking about yesterday, and this is Hin Leong, a Singapore oil physical trading company, and that they were already in issues yesterday. I said yesterday that they had a $800 million loss. Well, it turns out the figures get worse and worse from here. Now, they have had the loss, but it's all been stipulated because OK Lim, the founder of Hin Leong, was placing trades on oil, nothing unnatural for a physical oil trading company, and that's nothing out of the ordinary. But what is out of the ordinary is that Hin Leong has a non-hedging policy, meaning they don't hedge their risk against currency fluctuations and or oil price fluctuations on the inventory that they have. So at the beginning of this year, when oil was at $70 a barrel, we saw OK Lim place oil trades for long positions that were significant in size, and they have since naturally dropped. He was basing his ideology on, or the theory, that China would contain the virus and that we would see a dramatic rise in price because it would reflect that all of a sudden we've got a global growth because we had a slowdown in China and then a pickup because they've fixed the problem with this virus. But it's not been the case. It's not happened. And because of the no hedging sort of policy that they have, they've left themselves overexposed. But it gets worse. It turns out they've been cooking the books for quite a number of years now. And that is definitely going to be problematic moving forward because it means that $3.85 billion as a shortfall for lenders. And they have more than 23 lenders, including some pretty big names on the list like HSBC. And when it works out to how much money they actually owe versus the debts, well, the other issue comes in again, that the debt side of things and what they actually use as a guarantee on oil for the debts to cover that sort of debt, they sold the oil. So there's not much left for them to really give. They have very limited assets to fix this sort of situation. The next part to sort of consider in all of this is how much does the lender really get back? Reality is that for every dollar that these lenders have invested, they're likely to only get about 18 cents back. Not a good outcome. And because of the cooking of the books, the government isn't going to help out and bail them out. So again, not a really good problem. And I think that there are likely to be criminal charges laid in this instance because it is really negligence that we're seeing. Moving on from that, the next piece of information we're going to be talking about is on China. And not so much directly with China as information coming out of there, but what's going on around the politics on trade around the globe. Now, the US has obviously been quite firm. We were seeing really good trade relations at the beginning of the year between the Europe and the US and China. So that was all pretty good. We thought there was going to be quite a prosperous year for relationship building and help with trade between all these places. They were sort of working out their issues with all the trade agreements that were going on and the trade price wars that were happening. But now it's not looking so confident. The way that China has sort of handled the COVID-19 epidemic has been left a lot of people with questions in their mouth. For example, the change or the revision of how many deaths have actually happened has also been problematic. So we're now starting to see policymakers actually question what is coming out of Beijing and whether it is accurate reflection. We've had a number of entities wanting to get an investigation done to know why and how long COVID-19 was really in China, because it's evident that it has been for a lot longer than what's been let on. Now, there are a variety of other things that have gone on along the way. We have seen contracts that have been for medical and provisions to be shipped between China and the rest of the world because of the high amount of pharmaceutical companies and medical supply companies that are all doing their manufacturing out of China, with all of a sudden the contract prices changing during the middle of an epidemic. So even though they've had a long-standing contract because of demand principles, the prices have risen, and they've decided that we're not going to withhold or stand up to what we had in contract before, and they've basically been price gouging. So it's left a lot of bad taste in people's mouth. The next part to really consider is the weakened side of things. And this is when it comes to trade and the manufacturing. Now, it's obvious that there are weaknesses within the manufacturing side across the globe because everyone has been so heavily dependent on China's manufacturing that they've kind of left themselves very exposed to what's going on right now, where they are unable to run some businesses and that they are being forced to sort of get everything from China. So the EU and the policymakers there, and naturally the US has been talking about sort of bringing everything domesticated for quite some time, but now the EU is as well. They're looking at diversifying where they get their sources so that if something like this ever happens again, they are not restricted by just one source of some of the goods that they require, and potentially even bringing it back to a more nationalistic sort of an idea. A lot of it is coming from Germany and Angela Merkel, but that will be yet to be seen as to how far it really goes in the future. The next piece to sort of move on to is actually on the environmentally friendly side of things. Now, yesterday I spoke about Citigroup looking to take away financial services from any fossil fuel related industry or business. So this seems to be being pushed ahead very hard, and by 2025 they will not be having anything in any coal. And by the time it gets to 2030, they will be pulling all lending functions from all fossil fuel services and businesses around the globe. So this has kind of been pushed on to a number of other entities as well. We have seen the US sort of considering some of these implications. We have seen across the world, everyone sort of really taking account of the impact of COVID-19 and what actually happened from an environmental factor. So investors, board members, and those with voting rights are starting to think in that way, and to try and beat them to the punch and say that we demand that we have environmentally friendly options. We're starting to see some big names in the industry of banking and lending come out and bring funding to those sort of people that might need it. So putting special divisions in place that will allow for the environmental and the social side to be picked up on, and that more funding will go to it, and obviously targeting those sort of industries whilst cutting off fossil fuel related services entirely. So if you are interested in your environmental stuff, then I would be taking keeping a very close eye on what happens, especially with industries like Tesla and businesses around that sort of side of things, but also the solar and renewables and naturally sort of environmentally friendly options might be a way to start moving ahead. If this is going to be the case, then we might see a bit more of a rut for oil moving forward as well. The next one to sort of take a look at is, I'm really looking at the S&P 500 on this chart, but I'm really thinking about global equities and the differences or the movement between equities and oil that we're seeing. We're obviously seeing a big disparity between what's happening. And this is something to take into some serious consideration, because on one side of the fence, you sort of go, okay, well, are both sides exaggerating it? Are we seeing that equity markets and the S&P 500 are pushing for a V-shaped recovery here, or people are pricing in that sort of V-shaped recovery idea? Because that's what it looks like. If you look at the chart, it looks like a V-shape. It's pretty obvious. So is that something that's happening? And the reason that I'm thinking that that could be a possibility, and why the data is going to be hard to sort of analyze a little bit, is because in one side we're getting funding going in. We have seen the US and the rest of the world putting money towards stimulus, which is obviously boosting the economy, which makes investors think positive about equity markets. But then when we look at oil and commodity channels, we are seeing things tank. So are both sides exaggerating? I think they likely are. And I think that at some point we're going to have to meet in the middle. But I don't think that the V-shaped recovery is on the cards really at all. So definitely something to consider moving forward, and something just to really think about. Why are we seeing divergence between equity markets and commodity markets at the moment, and how is that likely to play out? And why is it that with stimulus we see a bit of recovery? Is that going to be sustainable? Are they going to be able to keep pushing money into the economy, considering the debt levels in the US going past $4 trillion, largest since we've seen since World War II, and some other places in the world, including Australia and obviously Japan? What is going to be the likely outcome? They're the sort of questions you need to be asking right now when you are taking considerations for your trades and longer term in sort of investments. But that's all I have for you today. I appreciate sort of you guys watching the videos and sort of the questions that I've gotten through from Talk to Al. I hope I have answered your questions. Naturally, if you still have more questions or you've got new ones, feel free to send me an email at talktoal@acy.com. And of course, like and subscribe the video so you can get more great content from me in the future. Have a great trading day ahead.